Welcome to Bayanat, the heartbeat of tech in MENA. We bring you raw stories and sharp insights from the founders, investors, and leaders building the region's startup ecosystem. Today, we are doing a deep dive into Monico. And this isn't, just another story about a neobank with a cool app. This is about a company that was basically forced by the market to stop being a consumer fintech and start building the actual foundational plumbing for a continent. We're talking about the decade-long mission of its co-founder, Bilal Dalab.
Exactly. And for you listening, whether you're a founder or an investor, this is a real blueprint. We're looking at how a massive, simple pain point, just cross-border access, was turned into a scalable piece of infrastructure for millions.
So let's start with the origin story, because it really sets the stage. Bilal Dalab's background is pretty fascinating. Swiss-born, University of St. Gallen, then the classic finance track. Private banking, BCG.
It sounds like a very standard global exec path.
And it does.
But that path gave him the exact tools he needed to see this huge systemic flaw. The light bulb moment wasn't some sudden inspiration. It was from being on the ground, working for BCG out of Casablanca, consulting for banks all across Francophone Africa.
So he was on the inside, watching the machine grind to a halt. What exactly was this massive gap he was seeing?
Well, the problem wasn't just, high fees or slow transfers. Those are just symptoms. The real issue was structural. African currencies just weren't convertible for international use. And the local banks, they didn't have the tech or the compliance frameworks to connect to the global system. They couldn't innovate.
So if you're an entrepreneur in Senegal, let's say, and you need to pay for a tool from the U.S.,
Yeah.
You're just stuck.
Completely stuck. The global financial system basically had an access-denied sign-up for most of the continent. Entrepreneurs couldn't scale, and everyday people were just locked out.
Okay, so Monica's first move seems a bit counterintuitive. They didn't start in Africa. They started in Europe, targeting the African diaspora. Why there?
Because that's where the pain was so immediate. You have to understand, European banks run on these heavy branch-based models. They want predictability.
Right, they want the salary, the utility bill, the local address history.
Exactly. They want to hedge their risk, as Bilal said. And a newcomer with cash, maybe some informal income, irregular transfers, that is kryptonite for their compliance systems. They just say no.
So Monaco steps into that gap.
They did. And for a while, they were one of the only neobanks in France where you could open an account with just a passport.
Wow, just a passport. No residency card, none of that French paperwork.
None of it. That was their entire wedge into the market.
But how did they get regulators comfortable with that? It seems like a huge risk from a traditional banking perspective.
They just used a different philosophy. Bilal's concept was to act like a wealth manager at a retail scale.
Okay, what does that mean in practice?
Well, think about it. A wealth manager onboards a high net worth client from another country all the time. They do it with deep due diligence, monitoring flows, not by demanding a local utility bill. Monaco just applied that same logic to the everyday retail user.
That makes so much sense. But this is where the story pivots, right? Because people back home in Africa started trying to open accounts.
And that was the defining moment. The team suddenly realized the demand wasn't just about moving to Europe. It was this desperate continent-wide need for basic global access. People needed international accounts for commerce, for remittances, and maybe most importantly, to protect their savings from runaway inflation. It proved the local systems weren't just inconvenient, they were failing on a massive scale.
So what does Monaco provide today? What's the solution?
Today, they offer a real internationally usable account, denominated in euros or dollars, and all you need is your passport or national ID and a local proof of address. That's the bridge they built.
And the economic impact is huge. I mean, for freelancers, it's a game changer. No more waiting days for a wire transfer that gets eaten up by fees.
Yes, but it's even bigger than that. It's about commerce. Their card actually works for global tools, SaaS subscriptions, ad platforms, things that just flat out reject local African bank cards.
It unlocks productivity.
It does. And
Yeah.
for people earning locally, like an Airbnb host or an exporter, it's wealth protection. They can hold revenue in hard currency, shielding them from inflation.
And the source material had a really staggering stat on that.
It's mind-blowing. In countries with dual exchange rates, where the official rate is a fiction, getting paid in hard currency through Monaco can increase the real value of your income by up to 40%.
40%? That's life-changing.
Absolutely.
Okay, but this sounds incredibly difficult to pull off. You're operating under a European license across all these jurisdictions.
Yeah.
How do they handle compliance when the big banks can't?
This is their real moat. It's all about differentiated execution. A traditional bank sees an unfamiliar document and just says no. Monaco built a system that understands the nuances. They run layered checks, email integrity, phone number history, digital footprints. They can actually read the documents, understand the context, and filter out bad actors without excluding millions of legitimate customers.
So they're turning what traditional banks see as pure risk into a usable data source.
Precisely. That's the innovation.
All right, let's shift gears a bit. From an investor's point of view, how is the business model different from, say, a Revolut or a Wise?
It all comes down to the default behavior of the customer. For a typical neobank user in, say, London, 95% of their spending is domestic, very low margin. With Monaco, it's the complete opposite. Their customers hold euros, but they spend in naira or dinars or francs.
So almost every single transaction has a foreign exchange component. Cross-border is the default.
Exactly. The FX spread becomes a core, powerful revenue engine. It's built right into their customers' daily lives. The unit economics are just fundamentally different.
But that sounds like it comes with a huge dependency problem. They're an orchestrator, relying on partner banks, card issuers.
A massive dependency. And they learned just how dangerous that is in a very high-stakes way.
The FATF gray listing incident.
That was the moment of truth. When several African countries were suddenly FATF gray-listed, their main European partner bank panicked.
And just cut them off.
Immediately, they stopped serving those markets overnight. Monaco's transaction volumes just collapsed, fell to a third of what they were.
That's a near-death experience for a company.
It was. They spent an entire summer just scrambling to replace that one partner to get the business back online. That kind of instability is completely unacceptable.
Which led them on this journey toward sovereignty.
Right. They had been an agent under a French license, totally dependent on their sponsor's risk appetite. So they went out and secured their own MSB license in Canada.
A money services business license.
It's a major step. It means they can report directly to the central bank. It gives them way more autonomy over where they can operate. It's not full independence yet. They still rely on partners for things like IBANs, but it's a huge move away from that dependency.
And that brings us to the long-term vision, the 5-star version of Monaco, which is all about end-to-end control.
And this is where it gets really interesting for the future of finance. They're using digital assets, specifically stablecoins, to solve a huge bottleneck.
Which is liquidity.
Exactly. A traditional remittance company has to park huge amounts of cash in banks all over the world just to have it ready for transfers. It kills your cash flow.
It's slow and expensive.
Stablecoins fix this. Monaco can now move capital around the globe, settle in near real time for a fraction of the cost. They run a hybrid model. Sometimes traditional rails are better. Sometimes stablecoin rails are better. They use whatever's cheapest and fastest.
So it's not just about efficiency. It's about building a resilient system that can't be held hostage again.
That's the North Star. The ultimate goal is owning the rails, connecting directly to central banks. For a company at their scale, that sovereignty isn't a nice to have. It's absolutely mandatory.
And bringing it all back home, the ambition isn't just to be a better consumer app.
No, not at all. The real ambition is the B2B play. The goal is to build the rail that integrates African businesses into global finance. If you solve the cross-border payment problem, you can fundamentally increase global trade for the entire continent.
So the end game is to actually contribute to Africa's GDP.
That's the scale of the ambition. This is a foundational company.
That journey, from solving one simple consumer problem to building sovereign GDP-driving infrastructure, is an incredible lesson for any founder. For more stories like this, subscribe to Buy-A-Nut's newsletter and stay updated on the latest in MENA's tech and startup ecosystem.